In this video, you will learn how term life insurance works, how families should pick the right coverage amount and term length, what real-world quote ranges can look like, which riders are worth considering, and how to break down the term monthly cost. Everything here is educational, not financial or legal advice, and your exact rate will depend on your age, health, lifestyle, state, and underwriting class. Start with the big idea. Term life insurance is temporary coverage for a specific number of years. If you die during that term, your beneficiary receives a tax-free death benefit in most cases. If the term ends and you are alive, the coverage ends unless you renew or convert, depending on the policy. For most families, term insurance is the value option because it delivers a large amount of protection for a relatively low cost. Permanent life insurance can be useful for specialized planning, but it is usually far more expensive. So if your main goal is income replacement, mortgage protection, and childcare support, term insurance is where many families start. Now let us talk about what best means. Best does not mean one single company for everyone. Best means the best fit for your household, the best price for your health profile, and the best policy features for your needs. The only way to find that is to compare multiple insurers and to understand what affects costs. Section 1. How much coverage does a family need? A simple starting rule is to think in terms of income replacement, debts, and future goals. Income replacement means covering several years of earnings so your spouse can pay bills, keep the home, and fund child care. Debts include mortgage balance, car loans, and any personal loans. Future goals include college savings, medical contingencies, and a buffer for inflation. A practical framework is this. Add up your mortgage payoff, outstanding debts, and a child care fund. Then add a multiple of income, often between 5 and 15 times annual income depending on how many years you want to cover. Then subtract existing liquid assets that you truly intend to use for this purpose, like savings, brokerage accounts, and existing life insurance for work. Here is an example. A parent earns $90,000 per year, has 2 children under 10, and a mortgage balance of $300,000. They might target 10 years of income replacement, that is $900,000, plus the mortgage, that is $1.2 million total before considering assets. If they already have $200,000 of employer coverage and $100,000 in savings, they might target around $900,000 to $1 million of term coverage. For many families, common face amounts are $500,000, $750,000, $1 million, and $2 million. Do not buy based on what sounds nice. Buy based on what closes the gap for your family plan. Section 2. Choosing the right term length. The term length should match the years your family is most financially exposed. If your youngest child is 2 and you want coverage until they are done with college, you might consider a 20-year or 25-year term. If you have a 30-year mortgage and you want the policy to track the mortgage horizon, you might consider a 30-year term. If you are in your 40s and you mainly need coverage until your kids are independent, a 15-year or 20-year term may make sense. Longer terms cost more because the insurer is covering you for a longer period, when the chance of a claim is higher. So a smart strategy is to match the term to the need, not to buy the longest term automatically. Some families even layer policies, for example, a smaller policy for 30 years for the mortgage, and a larger policy for 20 years for income replacement while the kids are young. Layering can lower cost while still covering the highest risk years. Section 3. What actually drives the price? Insurers price term life based on risk and competition. The biggest pricing factors are age, sex, health history, tobacco use, medication profile, height and weight, family history, driving record, certain hobbies, and the amount and length of coverage. The underwriting class matters a lot. Preferred Plus or Best Class can be dramatically cheaper than Standard. Even a small change in class can change your monthly premium. This is why families should never assume one insurer is always cheapest. Each company has its own underwriting niches. One might be friendlier to controlled cholesterol, another might be better for mild asthma, another might be more competitive for higher face amounts. That is why shopping and comparison matter. Section 4. Quote examples you can use as a baseline. I am going to share illustrative ranges, not exact offers, because rates change and underwriting is individual. Think of these as ballpark estimates to help you plan a budget. Example 1. A healthy 30-year-old male non-smoker, $1 million of coverage, 20-year term. A common ballpark might be around $30 to $60 per month. Example 2. A healthy 30-year-old female non-smoker, $1 million of coverage, 20-year term. A common ballpark might be around $25 to $50 per month. Example 3. A healthy 40-year-old male non-smoker, $1 million of coverage, 20-year term. A common ballpark might be around $60 to $120 per month. Example 4. A healthy 40-year-old female non-smoker, $1 million of coverage, 20-year term. A common ballpark might be around $50 to $100 per month. Example 5. Add tobacco use. If you are a smoker, premiums can be 2 to 5 times higher depending on the carrier and how recent the tobacco use is. Some companies treat vaping like tobacco. Others have different rules, so be upfront and compare. If you want a quick mental model, term life is cheapest when you are younger and healthier. Waiting even 5 years can increase premiums a lot. So if you know you need coverage, timing matters. Section 5. The best way to shop for the best term policy. Step 1. Define your target. Pick your coverage amount, your term length, and your beneficiary plan. Step 2. Compare multiple insurers. You can do this through an independent broker, an online marketplace, or direct quotes, but the goal is the same: multiple offers. Step 3. Choose a financially strong insurer. Look for strong financial ratings from major agencies. This is not about branding, it is about the insurer being there decades from now. Step 4. Evaluate policy features and riders. A cheap policy that does not fit your needs is not a bargain. Step 5. Apply and complete underwriting. Underwriting may involve a health questionnaire, prescription checks,